President Trump says the U.S. is imposing an additional 100% tariff on imports from China starting November 1st.
Yesterday, the crypto market lost nearly $19 billion in a single day. Bitcoin plunged below $105,000, its sharpest intraday fall in months. Ethereum tumbled, altcoins bled, and over $1.1 billion in leveraged positions vanished in hours. But this wasn't caused by a crypto hack. It wasn't an exchange failure, and it wasn't even a whale dump. It was a policy shock. One sentence from one man that sent the entire digital asset market into chaos. That man, Donald Trump. In this video, we're breaking down how a single trade announcement from the president triggered a chain reaction that slammed the global crypto market, liquidated billions, and flipped sentiment from euphoria to fear in less than 24 hours. And more importantly, what it means for the future of crypto. Stay till the end because this wasn't just a random crash. This could be the beginning of a new macro cycle. It all started with a midday press briefing. On October 7th, 2025, President Trump announced a 100% tariff on all Chinese technology imports, effective immediately, alongside new export controls on U.S. semiconductor technology. At first glance, it sounded like a repeat of the 2018 trade war. But this time, the world was different. More digital, more connected, and with crypto deeply entangled in the global financial web. Within minutes of the announcement, U.S. stock futures plunged. The U.S. dollar index spiked, a clear signal of global investors fleeing to safety. And in crypto, something snapped. Bitcoin began sliding from $114,000 to $109,000, then broke key support levels. Ethereum followed, and by nightfall, the entire market was red. By the next morning, $19 billion in crypto value had evaporated. But why did a tariff, a policy about imports and exports, crush digital money that supposedly lives outside government control? Because crypto doesn't live outside the economy. It is the economy's mirror. And when macro shocks hit, it's the first to crack. To understand the crash, you have to understand how macro mechanics affect crypto. The dollar effect. When tariffs rise, inflation expectations rise, and traders expect the Federal Reserve to hold rates higher for longer. That pushes up bond yields and strengthens the dollar. And whenever the dollar strengthens, Bitcoin weakens. The data is consistent. BTC and DXY share an inverse correlation of negative 0.87 over the past 2 years. Yesterday, DXY spiked above 108.6, while BTC dropped 8.4%. This isn't coincidence, it's macro math, institutional de-risking. ETFs and hedge funds holding Bitcoin futures operate on volatility models. When volatility spikes globally, they cut exposure. BlackRock's Bitcoin ETF reportedly saw $158 million in outflows on the same day, its largest since launch. China's shadow roll. Here's what most people missed. China still dominates crypto mining hardware and supply chains. Tariffs on tech imports mean mining rigs, GPU parts, and chip components just became more expensive, fueling fears of hardware shortages and slower network growth. Trump's anti-crypto history. Traders also remembered, Trump has never been pro-crypto. In 2019, he tweeted, "I am not a fan of Bitcoin and other cryptocurrencies, which are not money and whose value is highly volatile." So when he made an aggressive economic move, the market instantly priced in regulatory risk. And that's the key. The market wasn't just reacting to tariffs, it was reacting to fear of what comes next. Because if tariffs can be doubled overnight, what else can be? Stablecoin taxes, mining restrictions, exchange licensing. Once that fear kicks in, it spreads faster than any virus. By evening, the sell-off became self-fulfilling. The crypto market thrives on leverage. Traders borrow against their assets to amplify gains or losses. When Bitcoin broke the $110,000 level, liquidation bots kicked in. Thousands of long positions were forcibly sold. According to data from CoinGlass, over $1.1 billion in leveraged positions were liquidated in 24 hours. 85% were longs. The largest single liquidation? A $24.6 million Bitcoin long. On Binance, wiped out in 1 minute. Open interest dropped 11% across major exchanges, signaling mass capitulation. On-chain data from Glassnode showed exchange inflows spiked 43%, as panicked holders moved assets to sell. Fear overtook the market, not rational analysis. And that's how a tariff headline transformed into one of the biggest single-day liquidations of 2025. But beneath the chaos, there's a deeper story, because not everyone lost. While retail traders were bleeding red, some wallets were quietly buying. The same whales who dumped during the top were now back on chain, accumulating. So was this a crash? Or a reset? Why? Because whales understand what most retail doesn't. Macro crashes create crypto opportunities. Every major crypto drawdown, 2020 COVID crash, 2022 FTX collapse, 2023 inflation scare, was followed by higher highs months later. And this time, the setup might be repeating. If Bitcoin's structure mirrors past corrections, analysts project possible short-term lows around $98,000 to $100,000 before an eventual rebound, driven by post-crisis accumulation. Why? Because whales understand what most retail doesn't. Macro crashes create crypto opportunities. Every major crypto drawdown, 2020 COVID crash, 2022 FTX collapse, 2023 inflation scare, was followed by higher highs months later. And this time, the setup might be repeating. If Bitcoin's structure mirrors past corrections, analysts project possible short-term lows around $98,000 to $100,000 before an eventual rebound, driven by post-crisis accumulation. So if whales are buying while everyone else is panicking, what do they know that retail doesn't? To answer that, we have to zoom out, because this crash wasn't just about crypto. It was about the world economy pivoting. Again, Trump's tariff shock didn't just hit crypto, it hit everything. Asian markets closed down 3%. European indices followed. Oil spiked, gold rose, and bond yields surged. This was a classic de-risking event. Whenever risk aversion spikes, algorithms rebalance portfolios, dumping high-vol assets, rotating into dollar and bonds. Crypto, being the most liquid and speculative asset, becomes the first casualty. The irony? The stronger the dollar gets, the weaker crypto looks. Until it suddenly doesn't. Because once the panic fades, that same liquidity eventually flows back into high-risk assets, including crypto. That's the pattern every cycle. Shock, capitulation, accumulation, rebound. And we might be in phase 3 right now. Every crash feels like the end. In 2021, it was China's mining ban. In 2022, it was FTX. In 2025, it's tariffs. But each time, the same story unfolds. Panic sells the bottom, conviction buys it. Social media amplified the chaos. X saw over 1.4 million posts in 24 hours about crypto crash. Google trends for sell Bitcoin hit a 9-month high. The sentiment flipped instantly, from Bitcoin to $150,000 to is the bull run over? This psychological whiplash is what smart money relies on. They wait for retail exhaustion, then quietly enter positions while fear dominates the headline. So maybe the question isn't why crypto crashed, maybe it's who wanted it to. Because behind every panic, there's someone prepared to profit from it. Now the dust is settling and 2 paths emerge. Scenario 1, macro shock reversal. If trade tensions cool and DXY stabilizes, Bitcoin could rebound to the $100,000 to $20,000 range quickly. ETF inflows would resume and altcoins could rally again. Scenario 2, prolonged de-risking. If tariffs escalate and liquidity tightens, BTC could test sub-$100,000 levels before consolidation. Either way, fundamentals haven't changed. Bitcoin's halving in 2028 will still reduce supply. Institutional adoption continues, albeit slower. On-chain user growth remains intact. Short-term pain, long-term thesis, still alive. Analysts from Glassnode and Into the Block note that long-term holder activity actually increased during the crash, suggesting that conviction remains strong despite volatility. So what really caused the crash? Not a flaw in crypto, not a broken blockchain, but a reminder that even in a decentralized world, macro still rules. A single policy announcement, 100% tariffs, was enough to shake an entire trillion-dollar market. That's the power of perception, the speed of sentiment, and the volatility of belief. But if there's one thing history shows, crypto doesn't die from fear, it feeds on it. The market crashed because of a headline. The next headline might make it soar. So the real question isn't whether crypto will recover, it's who will be brave enough to hold when the world is panicking again.